I guarantee that 99% of the people watching this video has seen somewhere on the internet recently that a stock market crash is coming. But is this really true? Well, we're going to dig deep and find out the truth by listening to the big players and discovering something wild that may end this discussion. So make sure to watch all the way until the end. First of all, we have to understand the main reason people think the market is going to crash. And the first reason is the valuation of the S&P 500, which is the 500 largest stocks in the US. Now, if we pull up a chart of the PE ratio, we can see that the only times we had higher valuations than today were during the 2001 dot-com bubble, the 2008 financial crisis, and COVID. And what happened after we reached those peaks? The stock market crashed, turning into a full-on bear market. So does this mean we are about to crash? And should we sell all our stocks? Well, not necessarily. But before answering that, we have to understand the second big risk the market faces: the US debt. If we pull up the US debt chart, we can see it has basically only been increasing. The US is paying out hundreds of billions in interests every year, and that number just keeps growing. So, what does this mean for the stock market and the economy? One thing people include big players like Warren Buffett and Ray Dalio look at is the debt to GDP ratio, basically the size of the debt compared to the size of the economy. Right now, the US is sitting at around 120%, meaning the debt is bigger than the entire economy produces in a year. That sounds crazy, but it's not the end of the world. US has been here before, after World War II, for example, and still grew out of it. The important thing is whether the economy grows faster than the debt. If it does, the ratio goes down and things stay manageable. If it doesn't, interest costs eat up more of the budget, borrowing keeps rising, and that puts pressure on stocks, interest rates, and the economy. Now, considering that the market is getting more and more overvalued and US debt is increasing, does that mean we should sell all our stocks? Well, it depends on what stocks you own. If you own the S&P 500, it could be worth considering other markets. With valuations this high, S&P 500 companies need to perform perfectly, which they can, but the chances are small. That means the S&P 500 could underperform, which we don't want when we're trying to compound our money. But what about individual stocks? Should we sell them too? Well, stocks are different in the long run. In the short term, they can drop just like the market, sometimes even more. But in the long run, it depends on the company. The problem is, most stocks, even ones with big growth potential, don't survive a crash. So, what are the signs we want to look for in companies that can survive a market crash? First, they need a moat or a competitive advantage that makes them stronger than their competitors. Second, they need great fundamentals, which carries them through bad times. And third, they need great management, people who can lead the companies through a storm. So even in a bull market, we can still find cheap and quality companies that can also survive a bear market. Now, we have to discuss the elephant in the room. What are the chances of a stock market crash? I personally think we can't predict a crash. Nobody can. But we can look at the risks: rising debt and high valuations. If everything goes wrong at the same time, yes, we could see a crash. I would say the chances are around 20%. But here is the wild part. Even if a crash doesn't happen, there is another risk. The market could just move sideways for years, giving weak returns. Big players like BlackRock and JP Morgan have warned about this, and that can be just as dangerous because you don't lose everything at once, but you lose time. And time is the most important factor when compounding money. So, yes, these are risks, but I actually think there is a higher chance the market does not crash. And the best way to protect yourself is to own quality companies with strong fundamentals that can survive any environment. But then there's one more crucial piece to consider: investor psychology. The market isn't just about numbers and valuations, it's driven by human behavior. Fear and greed can push prices way beyond what fundamentals justify, and when sentiment suddenly shifts, it can trigger a cascade of selling. This is often how crashes actually happen, not just because stocks are overvalued, but because everyone panics at the same time. Think about it. When investors see falling prices, they sell to cut losses, which makes price drop even faster, causing more panic. This feedback loop can turn a small correction into a full blown crash. Even the most irrational investors can get swept up in it if the mood turns negative enough. That's why understanding psychology is as important as analyzing charts and depth. High valuations and rising debt set the stage, but it's fear, uncertainty, and herd behavior that can light the spark. And here's the wild part: the same psychology that can cause a crash also creates incredible opportunities for those who stay calm and stick to quality investments. And if you want to find stocks with great fundamentals, you always want to have reliable data. That's where the sponsor of this video, EODHD, comes in. They are an API key provider with some of the best fundamental data for thousands of stocks. Definitely check them out. The link is in the description. Thank you so much for watching. Now, if you want to see the best way of screening stocks in 2025, click on this video right here.